the recovery is actually starting with the quarter 4 of 5.6%. So recovery is starting. That recovery is premised on the policies that the government has taken. That recovery is going to create a very strong momentum. Now, the second thing is that we noticed that however much we tried to talk about the strategy to resolve the Eurobond, there was always some doubts. Why was there some doubts? A big portion of the market, especially our microstructure of the market, believed that the government will still go to the market to buy dollars to effect payments of the Eurobond. And that is why all of a sudden the market coordinated itself to speculate on the dollar, and they were buying as many dollars as possible to try and benefit from the time the government goes into the market. But I also found that when we were looking at where is the activity after the Eurobond, it was actually in the forex bureaus. It was not for those people holding dollar accounts. So in a sense, they were bidding the price. Now, the second part of it is that also potential investors would not come to Kenya because they are actually saying we cannot invest in that country because they have not resolved the Eurobond. So the market was acquiring what I would describe as a waiting option. You resolve the Eurobond and then let's come. So we needed a mechanism to dislodge the market from that waiting option. And that is why entering the market was very, very important. In fact, when we were doing the road shows, I was describing it as let us deal with the elephant in the room. So in a sense, we said, let's try to de-risk this Eurobond, and then we will see how foreign direct investment cases and even the exchange rate, how it will respond. And we have seen that it has responded very well. Now, there are three advantages for us entering the market. First, information was processed appropriately and it reflects what we had anticipated. So there are no gaps now. But the second thing is that we get refinancing, and even now we can supplement with the measures that we wanted to get to do. Your Excellency, but the buyback is still an option now because we got 1.5, and then it means that we still have to provide 500 million. But the third one is that we actually managed to restructure the maturity profile of future payments instead of having a bullet payment of 2 billion, because that is what was moving the market. 2 billion for that country called Kenya. Everybody anticipated that you cannot pay. And even the other side of the politics was saying they are going to default, just a matter of waiting. But even internationally, when there is a coup in Niger, the Eurobond price interest rates will jack, isn't it? So it means the market was not very well coordinated. So, but for us, we want to make sure that in future we are not beaten again by having such heavy ticket in terms of maturity. That is why we actually went for amortization in the last 3 years of equal amounts. In this case, 500, 500, 500. And which also plugs itself in years that we don't have other maturities. So that maturity profile is very, very important to Your Excellency in the future for two reasons. One, it can be seen that it's a maturity we can manage. And two, we can actually now start igniting a very strong liability management that is going to help us move in that direction.